Hey everyone, now it's time to focus on off-chain trading. And that's if you're looking to buy Bitcoin or Ethereum on a centralized cryptocurrency exchange. The most established ones that are considered regulated, licensed, and insured and pass the reserve liquidity requirements of actually preserving customer funds close to one to what's actually been able to be withdrawn are Coinbase, Kraken, Bitstamp, and Binance. And then a list of some of the more prominently used ones that have spot markets and also derivative markets, including perpetual futures, options, any form of margin trading, are ones like Bybit, OKX, KuCoin, Gate, HTX, and they have varying levels of risk that's being exposed to counterparty risk, to withdrawal risk, to vulnerabilities around information security concerns and considerations. They have different levels of track record. So please be very, very careful and proceed with caution. So what I want to do is walk through an actual example of buying an asset on a centralized cryptocurrency exchange like Binance. And I have a few dollars here to be able to process a few trades. So I have it in USDT. You can see it here. And what you'll see, traditional centralized exchanges will have this view. And the main thing that you have to pay attention to is how much are you actually looking to acquire? Because for each trade that you're executing, you need to consider the total transaction cost. And think of that as a fully loaded, blended cost of acquiring an asset. And that includes multiple components. One is the price of the asset. Second is the quantity of the asset. Third is the quantity drives slippage. And slippage is driven by liquidity. And then the third is your transaction fees, which is inclusive of commission costs and other related exchange-related costs. And it depends if you're a taker or a maker. If you're executing a trade yourself as a market order, then most of the time you're going to be an actual taker. But if you're actually driving the order book and you're setting more sophisticated limit orders and you're driving the direction of the market, then you could actually be considered a maker. And maker processing fees are lower than the taker processing fees in most cases. So all of those things are considered into how you look at the order book. So this is the order book, right? And what you see here is essentially the difference between the bid and ask. And the difference between the bid and ask is the actual slippage rate at the lowest amount. But the true slippage rate is how much is being driven by how much quantity you're looking to acquire. So there are people right now who are, and if we can aggregate it up. So if we aggregate it up by, let's go by dollar. So there are people, and this is the Ethereum USDT trading pair on Binance. And what this shows is that if I want to buy Ethereum using USDT, so you look at the numerator and denominator, the numerator is ETH, which means that I want to buy ETH using my denominator, which is my USDT. So I want to acquire Ethereum using USDT stablecoin. So a pegged stablecoin USDT, and it's close to 1-to-1 US dollars. And I just look at what are people willing to sell Ethereum today in USDT terms. And right now, the lowest that I could see, and this is rolled up by dollar, is 31.25. And the highest offer that's on the order book in this particular trading pair is 31.20. So there's about a $5 gap, right? And that disparity is essentially equivalent to what the slippage would be, right? So you'd have to increase what the highest bid is or the highest offer to be able to match up to the lowest available ask, again, for this trading pair and at this particular time. So if you want to do that, you can do it that way. Another thing is if you're looking to just buy quickly, you can just buy using a market order and just choose how much. So you would essentially change this. And the functionality is essentially 95% the same across all centralized cryptocurrency exchanges. So we're going to go through the main functions and the main modules that are within spot-based trading that you see here, right? So if I want to buy I have about $100 and I want to buy 25% of Ethereum using $25 roughly, right? And then it's not allowing me to control the market price, of course, because it's going to take the mark price or the last traded price or the best available price given this particular quantity, and it'll do everything possible to fulfill the order up until the entirety of the order is completely closed and finished, right? So as long as the requirements are fulfilled, then it'll close the order. So right now, if I want to buy ETH, it said market buy order filled, and there's a market buy order created, and then it was filled, and you could see that, right? So you see that with the B, and then you look at your trade history, and you see everything very clearly outlined here, right? So you see that we bought 0.0079 worth of ETH using USDT. We paid a fee of 0.0004740 ETH. And that was the fee. Now, if I want to sell, I can sell, and I can sell everything I have, which is everything that you see here, right? Which is basically the amount that we're looking to, that we just acquired. So 0.00785, right? And because the executed minus the fee is what our actual end amount is in our wallet, right? Now, if I want to sell, I just execute it. Now, but you also should know the important differences between a market order and a limit order, and stop limits, stop loss limits, trailing stops, trailing stop limits. There's a myriad of different advanced conditional orders that you should consider. And it's absolutely critical that you understand at minimum the difference between a market order and a limit order. So a market order is exactly what we just did. It goes to the best available price, and it goes up or down depending on whether or not you're opening a long. So if you're buying an asset on a spot order book like you're seeing here, then you're going long, then you're basically going up the order book on the red side, because you're basically buying what people are willing to sell and what people are asking for, essentially, right? So people are asking for 3136 and they're willing to sell $29,000 at 3137, right? And if you go up, so if we roll this up, and rolling it up, I think aggregates it and removes quite a bit of the noise as well. So I can buy up to 43,000 at 3140. So my average price is going to be 3137, and I will be able to acquire around 17. Essentially, it was 17. It's constantly changing, of course. But I know that, but roughly I can acquire around 43 Ethereum now at our average price of 3136, which is pretty good. I mean, the amount of liquidity on Binance on most trading pairs is good, but there's other competing exchanges like Woo that are known for having deeper order books for other trading pairs that may not be traded as frequently, right? So. And this is, again, how centralized exchanges work, is they work through a bid ask and an offer and a take type of order book, where you see the amount of demand and you see the amount of supply, right? So that's how it works for market orders. For limit orders, what you would be doing is you're saying, I want to acquire this asset at a predefined price, right? So I want to acquire 10 Ethereum, so 10 ETH, and I'm only willing to pay 3,100. So that is how much I'm willing to do, right? And then you execute the trade. And what it's going to do is it's going to open up an order that it's a conditional order that is only going to actually execute on the condition of the price of Ethereum dropping to 3,100. So some people, you'll hear them say, oh, well, I want to have I want to have basically bids and limit orders very, very low in case the price completely plummets and collapses and goes into like a stink bid, right? And what they mean by that is they're essentially setting limit orders at each interval. So think of it as a triangle. So as the price continues to dip and continues to collapse, you continue to acquire more and more and more. And that strategy is how you essentially would DCA in, and that's how you DCA in out. So you're dynamic cost averaging in and dynamic cost averaging out. So as the price is lowering, you're acquiring more and more of the asset. And your average entry is essentially going to be considerably lower than you just buying at 31.36, right? So laddered bids. So you're laddering them at each sequential level that you've set and you've defined as being particularly interesting and important. And by now, at this stage of the course, you would have learned, technical analysis and be able to identify support and resistance levels and Fibonacci retracement levels. And all of those are very helpful in being able to determine when to enter and when to exit particular trades, depending on your time period and your investment horizon. So that's literally how you trade. How do you get assets on a off-chain trading platform like a centralized cryptocurrency exchange? Is you have to go to a wallet, and then from a wallet, you're going to go in and you want to deposit assets. So if you don't have any cryptocurrency at all, then you would just go and connect your centralized exchange to a bank account, a bank checking account. And sometimes you can plug directly into using like Transact platforms. Even MetaMask, which is one of the wallets, has a built-in on-ramp solution. So all you do is ideally you just connect it to your checking account, and then from your checking account you deposit some funds directly into the cryptocurrency exchange. Then you'll receive USD dollars, and once you have USD dollars, you ideally want to then convert it to USDT or USDC. These are two stable coins that are pegged to the dollar again, 1-to-1. And then from there, the majority of trades, as you see in the trading pairs, are denominated in USDT or USDC. And that's what you see here. So these are all the different assets that you can buy using USDT. But if you look at just USD, it's only allowing 1-to-1 because this is Binance US. But the majority of positions in the market are going to be USDT and USDC. So if you look at just Binance, these are the reserve assets that I was just mentioning before around, which really helps establish legitimacy for them. So they have 129 billion in actual customer-driven reserves. And if you look at their trading pairs, see they have FDUSD, which is a new stable coin. They have USDT, and that's the majority of denominations. And then they also have they have different fiat-based currencies. They have some trading pairs denominated in BTC. So that's really what you do. So you plug in your account, you deposit the USD funds from your checking account, you convert it into USDT or USDC, you buy Bitcoin, you buy Ethereum, and then from your wallet, you can then withdraw some of your assets. And once you withdraw your assets, you can withdraw them to a private wallet or withdraw them to another exchange. And you're free to do as you best see fit. But that's ultimately, I think, a good review of off-chain trades. There are risks involved with keeping your funds on a centralized exchange, and you have to please be careful with that. You don't want to be so overexposed because I've been in this sector for a really long time. And I would say that the majority of cryptocurrency exchanges that I've interacted with in some capacity or another, I like to just go in and out very quickly. So I deposit funds, execute the trades that I need to, and then withdraw back to my private wallets, depending on what cryptocurrency it is. And the majority of tokens in the market are available as on EVM chains. So think of them as like Ethereum related tokens, and or layer 2 platforms that are built on top of Ethereum. So as long as you're sticking to an established token standard and reputable wallets, then I really see no reason to hold funds on centralized exchanges for prolonged periods of time, except if you're doing yield generating and you're participating in different staking mechanisms. This is available in many of the markets. And depending on like your legal jurisdiction and what's available, you basically will have access to some of these platforms and some of these modules around staking, restaking, and we're going to go through that later. But hopefully this gives you a good overview of what's available for off-chain trades. Thank you so much.